I want to welcome everybody. As many of you are on here, but those that are new know that there's a chat function that's up top that I just mentioned before, but next to it is a Q&A function. If you have any questions during this presentation, please enter it in. But to try and bounce between chat and Q&A, it would just, the network is unstable. It would just be very difficult. So make sure you enter your questions in the Q&A. I will be monitoring it. Please don't enter questions yet, because I guarantee if you enter a question right now, it's going to scroll up and it's going to get lost. So usually what happens, Mary, is a couple people on here that are regulars, and as soon as I say hi, they ask a question about the topic. That's on slide number 44 type of thing. So anyway, you should also see that there's a handout. It's not an extensive handout, it just has some information that Mary wanted to pull together and give to you. So you can go and download the handout. If you can't find it, if you don't get it, let us know. We'll send you a copy of it. As it is with other times, if you do want CPE, some people on here do prefer to get CPE. You have to answer the polling questions. There will be 4 polling questions as we go through. We'll do a test run right now because Colleen was yelling at me. So let me just send out the first one. So if you can answer that, has the limitation on SALT impacted you? And is anybody answering yet? Says open. There we go. Only one person answered.
Was that me, Brad? I think I answered it.
I heard you click, and I think it was you. I'm like, Mary, I know your answer. They're anonymous.
Yeah. So, and I just wanted to tell you folks that we don't have an extensive handout because today is just meant to be, an overview of how to prepare to have your taxes, get your taxes together. Because like Brad said, everyone has to do their taxes. So you need to find a way to help your preparers, to help yourself, not have as much stress about the day.
No, taxes and stress, they never go together.
Never.
I agree.
Never.
All right, so we have 80 people. We usually leave it open for about a minute until we hit, until we hit around 90%. We're right at the 90% mark. And I will close the poll, but 35% said yes, 13% said no, 10% said no impact, and 41% said not sure. So for those that don't know, we got Q&A. For those that don't know, the SALT is the state and local tax. Oh, Joanna, SALT is state and local tax. It was when the tax law changed a couple of years ago. They limited the itemized deductions on state and local taxes to $10,000. And if you live in New Jersey, real estate taxes sometimes alone go over $10,000. But okay, so that's the polling questions today. As we had indicated before, believe it or not, we are not doing a session on PPP. Chris is hiding somewhere, so we couldn't get him. So no, but we wanted to come up with a different topic. Mary Ford is a tax director at Sobel Company. She has over 25 years experience, started her career at one of the big 4. I don't know if it was big 6 or what it was at the time. Spent some time in private. And during that time, she started cultivating a practice of a niche of handling individuals and small businesses. And since then has really grown to be a expert in the area. Unfortunately for her, I have a lot of questions for her, crazy questions. We come along, and she's amazing at either having the information immediately available or getting the information for you, which is what you expect from your professional service provider. Is not that they have every answer, but they're able to get you the answer. So, Mary, I want to thank you for this upcoming season when I'm going to ask you all those questions, because I don't say thank you.
You got it. You're welcome.
So I mean, last year you went through a crazy, crazy time, Mary, because, around April 1st or whatever it was, they said, you know what? Don't rush. Don't kill yourself. We don't have to have it done by April 15th. Now I know because I have some caring clients who in the end of June where I said, where's your information? They said, well, we didn't want to rush you, so we decided to get you the information a little later. So we'll talk about that and about how you're helping me in that instance, okay? That's called enabling, by the way. But let's talk about those this year. I mean, when are the taxes due this year?
Yeah. Well, Brad, at this point, the taxes are due April 15th. We do not expect another pandemic-related extension this year. And that did make it rough on us. We had no summer because our tax season never ended last year. So we're happy that April 15th is coming. Although a lot of people did appreciate the extension last year. I think it was warranted given the crisis we were in.
The thing that was difficult is it just fed into everybody's procrastination. The good thing is it allowed them to delay the payment, but it goes back to getting the information together.
Yeah, that's a good point. I wanted to just make it clear for people that don't understand, because I get this question all the time. When you file for an extension of time to file, you still have to pay the balance that you owe, whatever it is. When you file your return, you have to pay at least 90% of the taxes that are shown on your actual return when you file it for the federal government. For the states, that varies. Like, for example, in New Jersey, you only have to pay in 80% by April 15th when you file your extension. You could have a little bit, room for error. So what does this mean? This means that you really have to provide a good amount of information to your provider, a tax preparer, in order for them to estimate that amount. And you want to overestimate because penalties for late payment can be substantial. They do accrue and they do add the penalty and interest.
So if we step back a second and let's just say that I owe $100,000, I anticipate I'm going to owe $100,000 in federal taxes. Okay. And whatever, forget about New Jersey for a second. I live on an island, but I owe federal taxes. It's not Long Island. And so I at least have to have 90,000 paid in.
Correct.
Right. By April 15th. Now, how do you know that I owe that 100,000?
Yeah, you have you have to estimate it, and you want to overestimate. Typically you can base a lot of your estimations on the prior year amounts, but typically, if for a lot of K-1s, there might be surprises and you can't file your return because you're waiting for K-1s from flow-through entities or businesses that you've invested in. This does make it challenging for a lot of people, but we always try to overestimate that number and have them overpay, and then they'll either can apply it to their estimated taxes for the current year or get a refund of it when they file their return.
Yeah, so the important thing is here, and I want people here, because as soon as people hear that they have to have all their taxes paid in by April 15th, and now you just said 90%, so they're like, ooh, I can only do 90%. But what happens is if you go from that 90 down to 89, it's a problem. Penalties start kicking in. You're always going to have to pay interest. Let's get that out of the way. You're always going to have to pay interest whenever you delay payments. And the IRS, while I don't agree with a lot of what they said, the IRS has pretty much said, if you've had the money or use of funds, you earned interest, we deserve interest. So there's some logic behind it. So don't try and get interest abated. But the penalties is the real problem that you're going to start hitting. And so don't stay towards the edge is what you're saying.
Right. We always like to get 100%. When you give us the amount, we have you paying 100% because you just never know. And that's our margin of error, that 10%, the IRS to keep.
Right. But the other kicker is what people seem to forget is you still have to pay next year's estimates too, which is also due April 15th.
Yes.
So what I usually recommend, and I don't know what you do, is when you do the extension, I include the first quarter for next year. So if I am short with my estimation for 2021, for 2020, I can grab from the estimate. And I'm just short on the estimate then.
Yep,
Right.
that's great. I'm proud of you, Brad. That's a good thing to do. That's and that's one check the person has to write or one deposit they have to make instead of writing two, one for your estimate, one for your extension. So
Well, I won't lie. That's what it came down to. Is I didn't feel like I have to explain to write two checks. Somebody said if you withheld 100% of your taxes from your previous year in estimated taxes, you'd have no penalty, right? And Mary, not this Mary, another Mary. Mary, that's different. That's the
underpayment.
I'll let you explain it, but that's what has right. Right.
Yeah.
Go ahead. I'm sorry.
Yeah, that's
Don't let it.
yeah, the IRS. Thanks. Well, the IRS requires you to pay in 100% to pay your taxes evenly throughout the year. So at the end of the year, you have to have withheld or paid in at least 90% of your taxes. So that's a different test. And there is a safe harbor calculation that you're thinking about, I believe. And that is if you pay in 100% of your prior year taxes for the current year that you're filing, then, or 110% if you're over certain income limits, then you won't be subject to the underpayment of estimated tax penalty. That's different than the late payment penalty for filing your return, not paying enough taxes when you file for your extension. It's they're two different penalties.
Yeah, and different concepts. So best thing is to just I recommend you have to estimate your taxes what's owed for April 15th, and I would recommend you pay 100% and have that little bit of a wiggle room. So,
Yes.
But that concept that you just brought up about the paying it by January 15th, is that new? I don't think that's new at all.
No,
The January
no,
15th,
not at all.
Right. So then what is new
that's
for
the
this
fourth
year?
quarter. So what's new for this year? So
Right.
go ahead. There's a lot of stuff that's new. It's really it doesn't affect the vast majority of people, but we're just going to touch on. I want to just touch on a few things that I thought would impact a lot of the taxpayers, and it does answer a lot of what I've been getting a lot of calls about so far. And I have an echo, Brad.
You sound like you're echoing a little bit, and you know the one thing I've noticed from the Zoom world, I'm letting it build up a little bit. The one thing I'm noticing from this Zoom world that we're living in now, people's echoes go in and out. Mary and I have been on calls now, or on this call now for 44 minutes because we log in earlier, and this is the first time her echo is that bad. So for people that are probably saying stuff where I can hear her echo, and we're hoping that the echo goes away, I apologize for it. So
yeah,
all
sorry
right, let's
about
try
that.
it now.
It seems better now.
Yep, exactly.
Can you share the screen that I wanted to show? The first change I wanted to bring to your attention, kind of give you some information on the tax bracket. One before that, Brad. Is there one?
One Yep, I got it. I'm going to it. Okay.
Okay, great. So for each year, the IRS does adjust your income tax bracket individuals to account for inflation. And I'm sure this side by side for the 2019 rate versus the 2020 rates. You can see that for the, let's just take a single individual. In 2019, they had their first $9,700 of income was taxed at 10%. That for the first tax bracket increased now to $9,875,000. Okay. Well, the question I get, Brad, and I don't know if you do, people say, what tax bracket am I in? Right? Don't you get that question a lot? The way you figure this out, and these tables are on the internet too. I mean, I love to hear from all of you, but I just wanted to show you if you wanted a quick answer. What you have to do is just, these are graduated rates. You would have to determine your taxable income, all of your gross income minus all your deductions. Take that number, come to the table, and you'll see, for example, if a single person that has $100,000 of taxable income he would be in the 24% tax bracket. Well, what does that mean? Well, he pays tax on the first $9,875 of income at 10%, and then the next range at 12%. But every additional dollar of income that he wants to add to that tax year would be taxed at the 24% rate. So that's why they call that your tax bracket. Okay. I guess that's all I really wanted to say about that.
And Mary, so I know I'm able to quote every line from the movie Animal House, okay? And so I've committed that to memory, but I'm going to be honest, I have not committed the tables to memory, and I'm sure that you haven't committed the tables to memory. So what happens is people will call up and ask, what tax bracket am I in? It's not an easy answer of, oh, I've got every level committed to memory. You see how it's broken out. And the other thing is, while Mary may have mentioned this, if you have capital gains, that's a different story. Capital gains may push you into a different bracket, but you may not be. That in and of itself is taxed differently too. So
that's a good point. Yep, capital gains and your qualified dividends are taxed at this point.
Right.
Everybody. Yeah, definitely. Yeah. The next thing I wanted to show you too is a similar concept.
Okay.
Standard deduction.
So.
Sorry. So
That's okay.
similar to the tax brackets, the standard deductions are indexed and increasing every single year as well by the IRS. So in 2020, the standard deduction is now $12,400 for an individual taxpayer. That's an increase of $200. I believe, and then married filing joint, $24,800. They increased from 2019 about $400. Married filing separate is the same as being single. It's half rather of the married filing joint amount, and head of household will be $18,650. So so standard deduction, what does that mean? That means that if you don't have any deductions at all, or very few itemized deductions, you can still take this amount. The standard deduction is sort of a floor. No matter what you have in itemized deductions, you can always take the standard deduction. You can't take both. It's one or the other. So determine which one's higher and more beneficial for you. You still need to itemize your deductions and provide that information to your taxpayer. It's a good exercise to go through as well, because the standard deduction amounts, if you file a state return, may be different, and it may be more beneficial for you to itemize your deductions on your state income tax return, and then you can still take the standard on your federal return, and then take and itemize on your state return. So once taxpayers, Brad, once they said, oh, I don't have enough itemized deductions, I'm not going to deal with that anymore because it's a headache and I don't want to keep the receipts, I would encourage you to still do that for your taxpayer, because there might be some benefits you're leaving on the table there. Okay. Brad, I can't hear you.
Tax Act of. Oh, sorry.
You're good.
I think they figured out if they mute me, you sound better. And I think that what they're saying is, Brad, shut up, because Mary sounds better. I think that's what they're saying. But no, we still had the deduction, but people were able to itemize more. And I know one of the big items that was a standard contributions. So I imagine this affects that. And have they made changes to charity? Yes. This year, Brad, when the CARES Act went into effect last spring, the IRS the government wanted to provide incentives for charities that were definitely hurting during this pandemic and this crisis we were in. So they provided a benefit for individuals who take the standard deduction, that they can also, in addition to the standard, they can write off $300 of charitable contributions this year. And those contributions have to be made in cash to those charities. It can't be a donation of any other in kind or
goods and services, but it has to be a cash contribution. And then you can take an additional $300 on your return this year, which was great. The
is that going to be on the face of the return, or where is that going to be?
That's
going to be on
the IRS changed the form this year, and they added an additional line for charitable contributions, when you're taking the standard. So you'll see it on there. The other benefit for charitable contributions is that they took off the limitation on the amount of cash contributions someone can make. If someone's wants to make a significant donation, they can actually contribute up to 100% of their income in this year for charities, where historically they were limited to 60%. This is all really great, but honestly, one of the things that I like to talk about with my clients is that a more tax efficient way to make charitable contributions may be donating appreciated stock, Brad, because by donating appreciated stock, you don't have to pay tax on any gain that you get a donation for the fair market value of that stock, and it's usually a much better deal for the taxpayer and the charity. That's I would encourage, suggest that as an option. However, when you make donations of appreciated stock, you are limited to only 30% of your income. So there's a limit to that. Included in this would be donor advised funds too.
Yeah, and that's one of the biggest areas where I see people could take benefit. I think that where people expect that they're going to get a big benefit is donating clothes and household items. And while it's good that you do that and you do help many different organizations, don't expect to get this enormous deduction for household items and clothes and books. They're not worth what a lot of people think that it is. So
yeah,
I still see people putting questions in the chat. Please remember to put it in the Q&A. I do, Mary, before you go on to the next topic, I do have to put out the next poll. So we do have people that are looking for the CPE. I think we figured out, or I figured out the echo. I had to turn down my volume, and I think it stopped cutting you out. Even Ed, if you live in New Jersey, do the level of taxes concern you? This is not a your thoughts are on the impact of New Jersey taxes are. Are you're done with the slides right now, Mary?
I am, Brad. Yep. You can pick a
great. So on the poll, again, I'm waiting for around 90% to come in. Right now, we're at 26% say yes, they consider moving. 50% say yes, but they can't do anything about it. 11%, 12% say no, and 13% say not applicable. So they live on that island with me. Okay, we're at 90%. So Mary, there's a quirky thing that's out there now I see a lot of, and I hear a lot of discussion about it. And it's not quirky, but me being 55 years old, I'm not involved in it, but I hear all the young people talking about it. And I see it on the tax return, and they're always asking about the cyber currency. What is there anything that we should be concerned about as it relates to tax reporting with this?
Yeah, that's funny. Did you know that there's a new question on the face of the 1040, Brad? And every individual taxpayer has to answer it, yes or no. It deals with virtual currency. So that's the cryptocurrencies that you're referring to. And this is an area that's very, very, very popular with our 30-somethings taxpayers. It's something that they do. They do that. They trade it. They buy it. They exchange it. And it is a reportable transaction. And because it doesn't really cover a lot of taxpayers, but what I want to make people understand is that the IRS treats virtual currency as an asset, not as a currency per se. So like an asset, like a stock, when you purchase stock, when you purchase virtual currency, that has a basis when you buy it. And then when you sell it or trade it or exchange it, then whatever that value is, you have to compare it to your cost basis, and you would have a realized gain or loss that must be reported on your Schedule D of your 1040 going forward. What makes this tricky is that there's no required reporting of this currency, similar to a stock sale where you would get a 1099-B. There's no formal reporting to the IRS. So it is the responsibility of the taxpayer to report these transactions and to provide that information to the IRS.
I mean, if they're using currency, so if I use a currency by video game A, I'm trying to act like a cool younger person. If I use a currency to buy video game A last week, and this week I use currency to buy something else, cookies online, do I have to determine what value I got on this day and what value I got on this day, and I could have a sort of gain or something?
Well, yeah, well, in that example, to buy that video game in cryptocurrency, you would have to first buy the currency, right? So the value is of the currency when you buy it, you have to know that number. And then when you purchase the video game, the fair market value of that game in US dollars, you would have to compare the two. That's
wow.
Yeah, so it's complicated. There's a lot of accounting that goes within this. So that's why the IRS is like, we got to get a hold of this, because could be a lot of value out there that they want to tax. So the way they're handling it to start is putting it on the onus on the taxpayer to answer that question. And they put it on page 1 of the return so that people they don't miss it.
Well, especially since the Bitcoin hit how much the other day in value? Did you see?
I did read something about it. Was it 1870? I don't remember.
No, I think it was 40 or 50,000. So I mean, I bought a million worth.
That's right. It was like 38,000. Yeah.
Not $1 million worth. I bought 1 million units. I'm Elmer J. Fudd. So a couple of people had some questions. They're jumping around a little bit. So if you can give me a second. I don't know if you're going to.
You're on mute, Brad.
Oh my gosh. There we go. Thank you.
Yes.
Thank you. We have a bunch of questions. I wanted to see if we can handle a couple of them. I'm selling my New York co-op at a loss in 2021. So this applies to next year. Question: may apply to some people this year. Primary question: I can't use the co-op loss against my commercial rent earnings. I don't know. She's selling a New York co-op, and I guess it's going to be at a loss. And she's also a landlord in Georgia. Can you offset the loss with the commercial rent earnings? So it sounds like it's a capital loss and rental income. Can you offset the two?
Well, if it's a business property, meaning they're renting the property, then it would be, and you're disposing of that property completely, then there may be an opportunity to offset the losses, right? It's a capital loss if it's an investment in that case, right?
Right. And if you have a carry. If you have a carryo, it sounded like it was their residence. So if it's a residence and you can't have a loss on a personal residence. I know that.
So two different properties, not the same
rental property.
Yeah. Okay. Right. Thank you for clarifying that. I'm sorry.
So I think we need,
capital losses are
okay.
limited to only offsetting other capital gains. And then once you've exhausted that, then you can only offset $3,000 of your ordinary or other income on your return. That's correct. You cannot offset any more. You have to keep it in buckets. That's the way I like to explain it to my clients. All your capital income and losses have to stay in that bucket, and you can only offset each other and then get an additional $3,000 each year. And then you carry it forward.
Okay, great. So two people asked similar question. I'm gonna say them both, kind of blended together. Is Is it most beneficial to make donations from an RMD? Wait 1 second. And then somebody said, can you please address charitable contributions directly from an IRA and how it's reflected on the return?
Oh yeah, that's a great question. I think that is a very tax efficient way to make charitable contributions. If you're of the young age where you have to start taking required minimum distributions, and you are charitably inclined, if you make a direct transfer from your IRA to a charity, you can reduce your IRA taxable amount by that up to $100,000 for that donation. And the way that gets reported is, as I just said, you reduce the taxable IRA amount on page 1 of your 1040. You still need to report the gross amount on 1040, but the taxable amount carries forward as a reduction by your charitable contribution. And there's a little code that goes on there that says you made a qualified charitable donation. That's how the IRS knows that's what you did. Now, this is a beneficial way of doing it because then it adjusts your adjusted gross income. It reduces your adjusted gross income, and you may be able to take advantage of like medical expense that other itemized deductions that are limited to your adjusted gross income. So it's beneficial there. So I think that's a great way to do it, a very tax efficient way.
Great. Ellen asked if gaming is considered a virtual currency, online gaming. So I think that what she might mean is, and Ellen, you can correct me, you know, those whole buying of the different awards and stuff like that. Or I don't know if she's talking about gambling, but I think she's talking about the video gaming and where you get awards for winning things and stuff, because they seem to have some sort of value.
Yeah, I think, you know, and I'm not, you know, a complete expert in that area, but understand in my readings of this is that would be considered mining of a virtual currency. If you get something of value that is fair market value in US dollars, then yes, that would be considered income, or it would be reported as other income, not necessarily capital gain in the other examples that I gave you, but yes.
Okay. So I see a bunch of questions, but I'd like to continue on with any of the significant changes each year, and we will try and get to to more of your questions, though.
Yeah. 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 Did you? The next thing I wanted to cover is the economic impact payments, the stimulus checks that everyone got, because this is a new thing on the Form 1040. There's a section for the the 2020 recovery rebate credit. The recovery rebate credit was paid out in 2 installments this year, and they were called economic impact payments. When these payments were paid out, they were calculated based on either your 2018 or your 2019 income. This will be reconciled on your 2020 tax return, because that's really where the credit should have been calculated. So there's an opportunity here for some people. If your income if you didn't qualify for the credit based on your 2018 or 2019 income, there's an opportunity then to qualify now in 2020 if your income has gone down. So or if you received a reduced credit because your income was in the phased out range, you may be entitled to a full credit in 2020 if your income has decreased. You do need to provide to your tax preparer how much you receive. That'll be a question everyone will be asked. Did you receive an economic impact payment? If so, how much? So because we want to reconcile that for you. Okay. And we're going to see is for dependent children, that maybe for your dependents for 2018 and 2019. And then they graduated last year. Now they're no longer your dependent. They'll definitely get that credit. So they'll want to get their tax returns filed.
So a couple things about this credit. I'm asking a favor for everybody that's on here, especially if we prepare theirs and their children's taxes. Please make sure if your children received a stimulus credit that they let us know. I know they're going to say, I don't know. The problem is if they don't know and we fill out that they didn't receive it, but they should have received it, I think there's going to be a problem with the filing. Is that correct, Mary?
Yeah, I mean, well, I originally thought that was going to be the case. But if they receive the full credit and they're not entitled to any additional credit, it'll be fine. Again, it's just if they're entitled to any additional credit, that we need to know that amount. It looks like the software is not going to limit us for filing as I originally thought they would.
Good. Okay, great. The other thing is I don't know where their checks are. Okay, I will say for accountants around the world, we don't know where their checks or the debt or the debit card is. We don't have a hotline to the IRS. The IRS hasn't told us where they're mailing stuff. I had a client email me and said, I really should have gotten this direct deposit. Can you tell the IRS to do that? I know that I do know some people in Washington, but not that depth of connection. So this is you had a comment at one point, Mary, about people electronically or not wanting direct deposit or automatic withdrawal. So that's what created the issue of people having to get checks or credit cards. Otherwise, if they had their banking information in their 1819 return, they could have gotten a direct deposit for the stimulus. So I don't know if you have any thoughts on the direct deposit.
Well, yeah, so the direct deposit, yeah, that was no, I guess the only thing I wanted to say is that a lot of, I found out they were doing direct deposits if they had that information. And then when it got crazy because, people, were losing their amounts, they were sort of issuing these debit cards, which people didn't know what it was and they received it. And a lot of people threw them away. So, they didn't open it and they said, oh, it must be junk mail. And then they just threw it away. So the IRS has done a very good job with their website. And believe it or not, you can go on there and find out where the status of it is or, let them know what happened. It's pretty good this year with that.
Right. All right. I'm going to have to put up the next poll. I'll ask the next question while they're looking at the next poll. Did you receive an advanced recovery rebate credit or an economic impact payment? So, Mary, while they're looking at that, I know that somebody asked about RMDs. Are RMDs going to be required for 2021? Do you know?
Yes, right now that was a one-time thing for the CARES under the CARES Act to give people a break when the market tanked at the beginning of the pandemic. In 2021, you still need to start taking your RMDs. The Secure Act, though, did make a significant change for taxpayers. The minimum, the age when you have to start taking your required minimum distributions has been increased to the age of 72. So that's beneficial for a lot of taxpayers who, are continuing to work now as well into their 70s. So.
All right. Now, somebody asked about and I'm going to shut down the poll. Somebody asked about the fact that we keep mentioning New Jersey. Can you mention New York too? So if you can say anything about New York, but I will be honest, most of the people on here are New Jersey. So for those that are New York, I apologize if you're feeling slighted. That's how we feel regularly and being in New Jersey, everything's New York, I love New York. It's never New Jersey. All right. So if you can mention anything about New York, but I knew New Jersey last year, going back to Jersey, I know New Jersey last year decided that they're going to maybe up their brackets a little bit. What was the big change this year?
Yeah, that was a shocker, Brad, because in September, when Governor Murphy signed that tax bill to increase the Millionaires Tax applies to, he made it retroactively back to January 1. Historically, the Millionaires Tax applied to taxpayers with income over $5 million. So if you had income over $5 million, you paid 10.75% on that income. Now, if you make $1 million, anything over $1 million is taxed at 10.75%. Where historically it was only like 8.9%. So this is a huge generator for the state. They anticipate that it will generate about $390 million for the fiscal year of 2021. So that was a big one for the state, for sure.
Colleen keeps muting me. I apologize, but I can understand why. She holds the power now. So they changed that. I know that the federal government here for the business owner, for the pass-through business owner, I will say that I was there the night that Alan Sobel conceived the thought of the New Jersey bait tax. I was standing there listening to him. Yeah, we were standing right outside his office. It was me, him, and one other partner. I won't say who, Ken Hydock. And Alan threw out this idea, and Ken Hydock said, "I don't think that'll work." And lo and behold, X amount of years later, because of his tenacity and the help of the New Jersey Society of CPAs and some other people and organizations, we've got the New Jersey bait tax.
Yes.
So what is that about? Now, there's going to be a lot of people on here that it will not qualify for. So it pretty much, I will say, it's for companies, pass-through entities, LLC, S-corps that have income this year. Let's say, I'll start with that.
Absolutely. That was a huge win for the taxpayers of New Jersey who own their businesses, and the businesses are flow-through entities. What this entitles, and this is the New Jersey bait, it actually helps businesses that were impacted by the SALT limitation that we talked about earlier, right? So business owners their income would flow through to them as an individual. They would pay tax to New Jersey on their business income, and they would only be able to deduct those taxes on their Schedule A, which was a big number, and it would be limited to $10,000. Whereas if you were a regular corporation, you would deduct it in arriving at your earnings to determine your tax at the state of New Jersey. So thanks to Alan Sobel and his and the group that he put together, New Jersey did say, yeah, I guess that seems fair. So now pass-through entities can if they pay the New Jersey bait tax on their New Jersey source income, they can take a deduction on their federal return, and a deduction against their flow-through income, which goes to their 1040 return. So they essentially get a full deduction for those taxes and arriving at their flow-through income on their 1040. And then what happens is those taxes will then go through to their New Jersey return. It gets added back to income for New Jersey, but they can take a credit for those taxes that were paid on their behalf by the entity when they pay their New Jersey tax. So I wanted to show that one of the things that it's very important, if you are benefiting from the New Jersey bait, you must provide the pass-through into the PTEK1 that shows the amount of bait tax that was paid on your behalf. This will have to be attached to your return, your New Jersey return, in order for you to get a credit against your New Jersey taxes when you file your return this year and going forward. And this is an elective tax, something that you would want to analyze each year whether or not it's beneficial. But I think we've seen it. It's going to be a huge win. People are going to save a lot of federal taxes based on this. Be a good one.
So the companies had to make the election by December 31st. If they didn't, you can't do anything about 2020. They now have to make the election by March 15th for 2021. And it's not the individuals, because we have a lot of individuals on here. It's not the individuals that make the election. It's the company that makes the election.
Yeah. And my understanding is they still have until March 15th to make that election, Brad, to do that.
2020?
For 2020, yeah. I thought that was the election to do that. Or was it 2021?
We'll have to see if Karen posts in the chat. Karen Henderson, who's our in-house specialist on it. But I thought they had to make the election by December 31st, and for 2021 they have to make the election by March 15th. So
yeah, I know we were focused. Yeah. Hopefully Karen can chime in there so we can get an answer for everyone. But I know that we were focused on December 31st for the cash basis taxpayers. So if they wanted to get a deduction, against their federal return, they had to pay it by December 31st. Make the deposit of their estimated taxes by then. Did she answer?
So we've got a bunch of people weighing in from the office. They've already told me Bitcoin's over 50,000. And Mary is correct. March for 2020. So March 15th for 2020. Thank you. That's why I'm an A&A guy. Oh, Michael Forges was moved over. Okay.
Yeah. That's
And
right.
so if somebody asks, can you overpay bait to make up for property taxes? So can you pay excess bait and then next year get a refund for it?
Well, you won't get a credit against your New Jersey taxes. You may potentially you may get a deduction against your pass-through entity income, but you're going to have to pick it up as income next year. And who knows what's going to happen to our rates and what's going on next year. I don't think that would, in the end, it's a timing issue, and I don't think it's a real benefit to do that.
I agree. All right, so we do have a lot of questions that are coming in, and I see some of the questions or some of the items that you want to talk about. I'm going to blend a couple topics together, and hopefully it hits a bunch of the questions. So we do have a lot of people that were out of work this year. They received unemployment. Is unemployment taxable for? Let's say they received New Jersey unemployment. Is that taxable in New Jersey? Is it taxable for federal? What if they got the additional $600? Other states they're still getting more. What about all these funds that people have fortunately gotten in that the government has made available to them?
Yes, Brad, the state unemployment benefits as well as the federal unemployment that was given out to the individuals is taxable for federal income tax purposes. And hopefully you had some withholding tax on that, because you do have to pay income tax on your unemployment. For state purposes, it varies depending on the state that you live in. For New Jersey does not tax your state unemployment or the federal unemployment benefits that were provided to you. So that's a good thing. The state of New York, however, follows the federal, and unemployment in New York State is taxable to the individuals. Mm-hmm.
New York State is taxable now. Okay, so and the extra $600 you said is taxable.
Yes, it is. Yes, it is.
I mean, it sounds to me like there is going to be a lot of surprise income this year.
Yes, I think so. It's because you're going to have to come up with the cash to pay your taxes, and I'm sure those were benefits that families really needed during that time. But yes, it is.
Yeah, because it sounds like people may not have had the withholding done properly on their. And you got to remember, if you just say withhold 10 or 15%, it gets blended in with your other income, and while you may not have a lot of income, still, your spouse may, and you may be pushed up into another bracket that you didn't expect. So,
yeah, I just want to point out to people that you will not, for New Jersey, they don't mail out the Form 1099-Gs. That's very important. You're going to have to go on to the online to your account for the state of New Jersey, and the same with the state of New York, and print out the Form 1099-G. That must be provided to your taxpayer. That's always one that can be a surprise for people, when they submit their tax information, because we'll ask for it. And if you don't report it, the IRS for sure is going to send you a notice, and you don't want to do that. That's one that can be missed sometimes by people.
Oh, absolutely. I mean, so what's concerning me is, yes, we do know some of our clients were unemployed, but some of them may slip through the cracks that we don't know about, or they didn't mention it, they didn't put it in the organizer, and that is going to automatically get notices sent out to them.
Absolutely, yeah.
Right. Good. What's going on with the 529 plans? I know that some students, use 529 funds and they wound up being home for school. Anything change with that?
Yeah, no, the IRS is onto this, because the way the 529 plans work is, if you take a distribution, you must use it for college-related expenses. If during the pandemic your child was sent home, the university refunded a portion of room and board, which happened a lot. I know I got some back. If you don't then in turn use those funds for other college-related expenses, you will have to pay tax on that income and pay a penalty since you didn't use it for college-related expenses. New this year for the 529 plans, though, those distributions can be used to pay down up to $10,000 of student loan debt. So, and it doesn't have to be for the child that's in college. It can be for another child that has some student loan debt. You could apply it there, which would be a good thing to use those funds. You know, the other option, you know, it's too late now. A lot of people, what I told people is you need to put the money back into your 2529 plan within 60 days. But a lot of people, you know, didn't focus on that. We were in a crisis. So something that we might be seeing more of on returns this year.
Okay, that's interesting. So I see we're getting down to around 8 minutes left. We do have a bunch of questions. There's a couple other topics we want to go over. Let me put out the last poll just so we can get that out of the way. How do you receive your tax return from your preparer? I mean, the world is going more electronic right now, Mary, and you know, I know that we normally send out paper organizers, which I say I would probably have 50% filled out. But some of them come back to me still in the sealed envelope that we mailed it in. And this year we opted to stop. We opted to save trees. We didn't opt to make people's lives harder. We opted more to save trees. So I want people to understand that that was our reason to do it. If you prefer a paper organizer, we can email it to you. You can print it, or we can mail it to you. But we really want to focus on the people that were filling them out. How should people try and get their information to their provider this year, and particularly us this year?
Yeah, I really want to encourage everyone, Brad, this year to submit their information electronically if they can. You know, we're still living with restrictions on meeting face to face, and you know that's just not going to happen this year. So if you send us the information electronically, we have a secure way of doing that for you, and all you have to do is scan the information in. I know that might be difficult for some people, but it really does save time, because then we can just download the information and we have a way to process everything within our processes on the 1040 group. You know, a lot of people, you know, if it's not something that you're comfortable doing, we do, a lot of firms do provide like a lockbox you can drop it off at, or if you do decide you want to mail paper copies to us, I encourage you to get tracking information. The U.S. Postal Service has been very challenging this past year, and you know, if you don't have tracking information on your tax documents, those are all personal things. I've been with people who have nightmares about it. So definitely get.
And it's funny, Ellen just posted up there, do not send through USPS. Not that we are anti-USPS. So there might be a postman on here, or a postman with a relative with a postman. It's a postman. We're not against the USPS. It's just the things have been delayed, especially with the whole corona because of shutdowns and stuff. So as Mary said, make sure you use some sort of tracking mechanism or send electronically. That's how we've been getting a lot of information now.
Yeah, that's been working really well for us. But I do ask people to consider gathering all of your information at once. You know, don't send it piecemeal, because we're dealing with such a huge volume of information. If you're doing it piecemeal, it's really difficult to track and keep it all together, and it really does slow down the process. So we appreciate it if you could kind of do your work in gathering your tax documents. You know, do it all in one afternoon. Do it on a Friday night. Open a bottle of wine and say, I'm going to do this and I'm going to make it fun. And try to do it all at once, and don't do it piecemeal. It's too difficult for you to know what you gave us and for us to process.
I think you just gave the recipe on how to ruin a good bottle of wine.
Oh my gosh.
I think actually, honestly, if it's taxes, go with something harder. Okay.
Yeah.
So, and I think the reason why you're saying about, you know, the not meeting with the people, I mean, you know, I know that you think that Sobelco, that's our color is blue at Sobelco, but these are not Sobelco's fancy blue walls. I'm in a converted bedroom. Mary, I don't, that doesn't look like your office over in Livingston.
No.
You're working from home.
Yes.
And I know people want to meet, and I'd love to see you, but you know, not many of us are meeting right now with people. And I think that it's not just us, it's not just Sobelco, it's a lot of companies. So a lot of people are working from home. Is there any benefit, tax benefit to working from home, i.e. home office deduction?
Yeah, I get that question a lot, Brad. I'm sure you do too. So with everyone working remotely, if you are an employee of a company, the answer, I'm afraid, is no. There's no benefit there. You can't write off your internet. You can't write off a portion of your home office. You may be able to work out something with your employer to get some kind of reimbursement, but I don't know. That's that may not be the case because you're not having to commute. You can, you're saving money there. The home office deduction is really dedicated towards self-employed individuals that or have a business and they're working from home. So if you have, let me back up. The reason that employees can't do this anymore is because of the changes with the Tax Cuts and Jobs Act. They eliminated the 2% limitation, the 2% itemized deductions, which is where the employee business expenses were once deducted. Once they took that away, they took away the ability for you to possibly write off a portion of your home and your internet. The self-employeds, the rules are the same. They haven't changed. I just want to say, make sure it's a dedicated space, Brad. Working at your table isn't a home office because you can also eat there. The IRS does require that it has to be a dedicated space for work only.
Yeah, I remember reading an article years ago, the horror story article of some, the IRS agent going out and measuring the desk. A client just emailed me the other day that, their husband is working from home for their business, for the business he has, and he occupies 300 square feet. And I responded back to them, that's 10 by 30. That's a very big office. It has to be dedicated to business, no personal stuff going on. I said 300 square feet sounds a little bit large to me. So they went back and they added up everything. And sure enough, the husband did have lateral cabinets and a couple areas of file cabinets. So then they added it all up. After they added up all the other little areas, it came out to 188 square feet. So they were able to find it, but it was far below the 300 square feet. Yeah. And what I find, this is Brad's editorial comment. What I'm finding is that when you go through this whole hassle, a lot of times it's not worth it. But I did see recently, and I don't know if you know of this one, that there is a simplified calculation. I don't know if you saw that.
Oh, yeah, definitely. So if taxpayers, if they don't want to go through the trouble of itemizing all their receipts, if they don't want to depreciate a portion of their home, because that's something that when you sell your home, that would have to be recaptured and reported as income. You get the deduction now, and when you sell it, you got to pick it back up into income. You can use a safe harbor method, which I think it's $150 for each square foot of your home. So it's something. I think the max is $1,500. It's not as big of a benefit as if you were to take your actual expenses, but your exposure is less and you won't have to pick up income later. So it is a good.
So we're at the hour mark, and there are a bunch of questions that we will look at after. Mary, you were nervous that there wasn't going to be a lot of questions on this. We're at the hour and we got a lot of questions still. I'm happy to, if people just say hurrah, I will ask Mary to come back because she wants to just feel loved that way. No, I'm kidding. Try and get Mary back if people want to hear more, ask your CPA type of stuff. But there was one critical question that I did want answered. Ken, one of our clients, asked the important question: is the wine deductible for the tax prep?
I love him. Okay. I love him. Well, a cost of preparing your return, but unfortunately, that's no longer a tax deduction because of the TCJA took that tax preparation fees away from you.
You tried, Ken. You tried. That's why I always like you. So we are at it's 9:31 now, Mary. Is there one final closing comment that you wanted to try and make?
Oh gosh, I would have to say the one thing is please, when you get your tax return completed, send back your 8879s, your e-file authorization forms to us right away. What happens is if you owe taxes, you can pay your taxes after we file your return. You don't have to pay your taxes at the same time you file your return. It really does become an administrative task to gather all the 8879s so that we can make sure we file your return by April 15th. We spend like the last 2 days just calling people. Where's your 8879s? We sent your return to you in February. Where's your 8879s? Please send them to us as soon as you review your return. Send them back to us. If you owe taxes, pay them on April 15th.
Thank you very much for saying that, because I hate chasing down the 8879s. It would definitely make it much easier. So at this point, I apologize that there are so many questions. There's just and Mary did have a list of items that she wanted to go over. It's just so deep, and we didn't hit on all those items. So
yeah, I'm happy that this has been worked out well. I'm happy this worked out well. That people were really into it. So we weren't sure how this.
Listen, I thought that didn't think you were going to get more questions that I get on A&A, but I think you did. Okay. No, Mary, thank you very much for the information. I know that there's a lot more. There are questions. We will try and circulate the questions in the office and have some people get back to you on the questions, or post the answers somewhere. I know that I see bait is a question that's still coming up, and some others regarding RMDs. So 1099-G is a 1099 you get from the government. Just trying to hit on a couple things. Regarding the stimulus checks, if they haven't gotten it, as Mary said before, Google the IRS stimulus checks. Where's my check? You can go through and get that and try and find out that information.
Yeah, that's IRS.gov.
There are a lot more.
It's great. Yeah, IRS.gov is where they want to go, and it's right on the page. Stimulus payments. It's
IRS.gov, not IRS.com, because that's probably a bad site. So IRS.gov. Okay. Yeah. Where's my refund? You can check there. The same thing in New Jersey. When you're look for a refund, you can check there. So, but we will look through all the questions. Our next session is going to be, I think, on March 4th. And Colleen can chime in if I'm wrong in any of these areas. I think it's going to be on March 4th. It is going to be on, give me a second. I don't see Colleen chime in. It is on March 4th. Alan Sobel, and it will be a round table with a couple attorneys relating to, I'm trying to see, Attorney Deirdre Wheatley-Liss, business exit planning. So with Alan Sobel, Deirdre Wheatley-Liss, and Attorney Brett. So I recommend people, join up for that. But I do want to thank you for attending. I want to thank you for all the questions that you asked. It showed that you were very, that you found what Mary was saying very interesting. And I look forward to having Mary back. You did a great job, Mary. So
thank you, Brad. Thanks for having me.